Jahangir is
Yes.
ready. We can connect with him. Good morning, Jahangir. How are things? Which part of the world are you joining from?
This is New York.
I always have to check with you that which part of the world you are from. So it's going to be it's been a long night, and it's been an ugly morning for Asia. What should we expect
Yes.
now after yesterday's inflation print?
Look, I think, clearly the inflation print was higher than expected. I think the details were worse. Even though, headline inflation came down, it didn't come down as much that people expected. We did see energy prices slowing down, food prices slowing down, but the real ugly print was in core services and core goods. I think much of the services inflation pickup was sort of anticipated, particularly on the rent side. I think what was really surprising was on the good side, that good prices were still going up. Now, I think, in terms of what it tells you about the US economy, it essentially tells you that, look, headline inflation is coming down, and that should be supportive of consumption going forward. Core inflation is going up, which means that consumption remains pretty resilient. On the other side, we've seen capital expansion intentions, which had been falling down, now turning up. And I think that, in the second half of the year, the US is poised to lift up and perform better than the first half of the year. We had, minus 1.25 annualized in the first half. And so all this talk about, slowing down and recession, if you look at the data flow is telling you that the US economy is getting out from that minus 1.25, 1.5 annualized growth rate in the first half to a positive number. And that's, nothing to scoff at. The largest economy in the world is going to move up from negative territory to positive territory. Not a large positive territory, but positive territory nevertheless.
Jahangir, if it is 100 bips rate hike, which US Fed could do, what happens to the world?
I think, when let's look at the month before this, right? The month before this, when inflation surprised on the downside, we all went and said, well, the Fed will take off its brake off its accelerator. You required almost all the FOMC members to go on a verbal guidance saying that that was wrong. In fact, and you had the Jackson Hole meeting where Powell laid out that, that is not the way in which they're looking at the world. I think the fact that the inflation surprising the upside has some meaning to it, but I do not think it alters the course that has been laid out by the Fed. And I think, 75 basis point is probably what's going to take place in next week. What is interesting, or what the market will look for, is that what does the Fed say about the next set of rate hikes in November and beyond? And I think that's where most of the conversation will be and the attention will be. I think going 100 because, inflation surprising the upside by 0.3%, that's a bit too much. It's still the labor market that the Fed is focusing on, and it's the labor market that the Fed will focus on, I think, for a pretty long time.
Are the worries persisting now that this prolonged period of policy tightening from the US Fed could tip the economy over the brink of recession? And how worried should we be back home as well?
Look, I mean, we have been, talking about recession risks, from the beginning of this year. Everyone has their recession models, and it was 40% at one time, 50% on one side. But if you look at recession risks compared to what used to be the case, 3-4 months back, and today, those recession risks have come down. I think that, it is easy to say that there will be a recession in the future. That's not even a call. There's always recession in the future. The question is, when does it happen? And I think that all the fears that we had in the middle of in the first half of this year, that recession would take place in the second half, those tail risks have been taken out. I think you will likely have a recession at some point in time, but we don't have a recession in 2023. And we really don't think that, the world will see a recession in recession 23. at some point in time, there will be recession. It always does happen. But I don't think that these kinds of calls that, recession is 6 months down the road because the Fed is going to raise to places where it hasn't taken it. Those I think are still exaggerated. I think you are still seeing an enormous amount of strength in the labor market. The labor market strength continues. You really require the labor market to go down to, let's say, hundreds or 100,000 or non-farm payrolls before even, you can think about, the Fed being in a place where it is going to start getting concerned about recession risks. And that, I think, is, a long way off at this point.
Yes, Jahangir, of course, we'll watch out for what the US Fed does next week when they meet on September 20th and 21st. But we also have the RBI MPC lined up for the end of the month. And even the inflation figure back home came a little higher than expected at 7%. And the murmurs have started back home as well, whether there'll be a 35 basis point hike or 50 basis point hike. Do you think 50 would even be realistically on the table?
Our sense is that it's going to be 35, right? And maybe there is some upside to it. But I think, we've been worried about the growth risk and inflation risk, and growth is not, has disappointed. Inflation is rising. But really, India right now, including the RBI, should be worried about the rise of twin deficits. That amidst all of this, we've sort of forgotten that, we have a fiscal deficit that's state plus center that's running around 11.5%, 12% of GDP. We have a current account that's running at 4%. India can't sustain current accounts at 4% level. We are usually at 2.5% of GDP. We sort of, at that edge. 4% of current account deficit is not sustainable. And I think the issue of macroeconomic stability, I think, should be the one that RBI should be focusing on rather than narrowly on inflation. And to what extent does interest rate or its own intervention policy mitigate or worsen that macroeconomic stability? I think that should be what the RBI should be grappling with at this point in time, rather than whether they should move 35 or 50 because inflation is at 7%. I think that story probably is no longer as relevant as the fact that we are now running current account deficit at 4% of GDP. We know what happens to India when they start running current accounts at these levels.
Okay, Jahangir, we'll let you go on that note. Thank you so much for joining us this morning and making sense of what's happening across the globe as well.